Well, good evening, everyone. This is AJ Monty, Chief Market Strategist for the Market Guys, and this is our monthly open house Q&A where I will go over some market insights and look at some of the indices, and I'll answer your questions, and we're going to go over your stock symbols. We get a lot going on. For those who are new to this broadcast, I just want to bring something up. I'll bring it up now, and then as people hop on a little bit later, I'll repeat it briefly at the end. We started back up with the weekly market report, and we center here in the website. We have a $1 offer for the first month, and then it's going to be a fee-based report. This is the least expensive report that we have, and the reason for that is we were doing a lot of business up in Canada, and they changed the spam laws, so people actually have to opt into services. We cannot broadcast out. They changed the rules. They made them a lot more strict. It's even becoming harder for the brokers to even communicate with their clients, which is unfortunate. But for the Oracle subscribers, for those who are getting trade alerts from me each and every week, this market report is included as a value add. So if you are interested in this, just go to themarketguys.com, click on the shop button, and you'll see it'll bring you to the page where it'll highlight some of the other services, and then right there at the bottom it says weekly market report. So that's all I'm going to say about that right now. And let's go to the charts. I'm going to start off with the VIX. If you're not familiar with the VIX, or if you've not been tracking it, this is one of the most important, if not the most important, indicator that you could put on your watch list. The volatility index basically measures not just the volatility of price movement, but it's a gauge for investor emotion. Really, when the markets get heated up and excited, volatility goes up. Well, when the volatility goes up and those emotions are running high, the S&P generally drops in price. And so today you saw a drop in the volatility index. In fact, this is I'll zoom in here. This is a bearish engulfing pattern today with this, which means the volatility index could drop a little bit. And if the volatility index drops, the S&P will go up because they're inversely related. Now, don't think that this is just a buy signal to get your long positions back on. I believe this is a temporary drop in the VIX, and I do believe that the overall markets are in for another wave of big selling down the road, and I'll show you exactly what I'm talking about so you don't get caught in what I call a bull trap. This former resistance area back here around 17 is really where I think the VIX is going to drop to, and I'll draw that horizontal line right there. I think the VIX could drop a little bit more before bouncing and going higher. The reason I think it will bounce after this bearish engulfing pattern is because there is a gap up here. And if you followed the VIX for any length of time, you'll see that 100% of the gaps, with the exception of the last two gaps, 100% of the gaps over time have filled. 100% of those. So there's a very strong possibility that the VIX is going to go up to fill this gap, and if the VIX goes up, the S&P will drop. Let's go right to the S&P so I can show you. Oh, wait, you know what? Let me go back, and I want to show you the monthly chart of the VIX. And this is, again, why I am so on top of this. This is 20-year history of the VIX, and you can see that the low support level, historic lows, excuse me, have been right around 10.5 to 11, right down here. Historic lows for the VIX. Now, if the VIX is still very close to historic lows and we think the VIX is going to rally, then what does that mean for the general market? If the VIX is going to rally, the general market could drop. And I do believe that will happen. In the weekly market report for the past 2 weeks, the accuracy of the charts have been very exciting to say the least, because they've come right to the penny in most instances where the market has dropped to a support level, rallied, pulled back from resistance, and fell. And if you look at the SPY, which is the spiders, you can see that we just crossed this horizontal line. And again, I'm going to repeat this for those of you who have been tracking the weekly market report. These horizontal lines are the 7-year cycle for bear markets. If you look back in 2000, we hit a high. Markets fell off in a dramatic way. We lost 50% of the previous up move in half the time in 2000. This, for those of you who remember the Y2K, right? Remember, we thought the world was coming to an end back then. Well, what was happening is the tech bubble burst. That's really what happened back in 2000. It wasn't Y2K that hurt the market. It was the tech bubble. And so the market came down. Then, look what happened. In 2007, again, 7 years later, we hit a high. And then the crash of 2008 followed. Here we are, 2014, right at the line again. And I'm already starting to see a breakdown in this trend line, which was pretty extreme, starting back here in 2012. We now have breached that trend line. We are now going lower, and we are at the 7-year cycle line. We're right on it. So, again, if you're feeling pretty bullish right now, I would, again, carry your parachute with you pretty closely, because that parachute in the form of stop loss orders are going to save you, and you really don't want to ignore that. Now, if we look at the Russell 2000, I'm going to look at the Russell 2000 now. I did not put the cycle lines on the Russell 2000. You could, of course. You can see back here in 2000 we hit a high in the Russell 2000, just a more broad-based index here. And you can see very interesting thing happen. Again, this is a monthly chart. It's a monthly chart on the Russell 2000. We have a bearish engulfing pattern here on the monthly chart. When something shows up on the monthly chart, you have to be very mindful of what's happening there. Monthly chart bearish engulfing pattern here. Not too long after that, we had another bearish engulfing pattern back to back, followed by another bearish engulfing pattern back to back. And you can see how the monthly chart is starting to roll over to the downside. If I zoom in here to the weekly chart, and I'll continue to zoom in, you'll see that on the Russell 2000, I'll zoom in here, this is a complex head and shoulders pattern where you have a shoulder, a head, and a right shoulder. And I'm going to leave these lines because this is what I drew on the weekly market report, and I'm going to need that for next week when I do the report again, because I want everyone to be following the accuracy of the charts. And, you know, I got to qualify this here. It's not my ability to look into the future. That's not what I do. I don't have a sixth sense that tells me when prices are going up and down. I'm simply looking at price action. I'm looking at supply and demand on a price chart. That's all I'm doing. And when demand breaks down, what does that mean? If all of a sudden the buyers dry up and there's no longer demand, prices will fall. And that builds up overhead supply, and you know the equation from there. So what we have is a breakdown. Here is a head and a shoulder, and this down here is the neckline. I could get rid of that line there for a second. Let me get rid of that. Pardon me. Remove the drawing. There we go. And we have a breakdown of the neckline. So I'm not that, again, optimistic because we are still going lower. Now, as I zoom into the daily chart, you're going to see that in the weekly chart, that the weekly market report, what I did is I said we're going to move up to this role reversal resistance. So we still have a bullish engulfing pattern here, right? And we have this resistance line to deal with. This blue line, now again, this is a Russell 2000. It's a more broad-based index than the diamonds, which is only 30 stocks. Even if it breaks out over this resistance, the next resistance line is going to be the 50-day moving average. So you have a lot of resistance up here at the top that we're going to have to fight if, in fact, you're still trying to find a reason to buy into the market. Okay, let's keep going. Let's look at the diamonds. The diamonds. This is the Dow Jones Industrial Average ETF. This is my forecast right here of what I think the trend's going to do. I think it'll move up to resistance and then pull back. That's opportunity. Remember, with every down market, I don't care if it's the Dow, the S&P, the Russell 2000, the Qs, NASDAQ, with every down market, there are stocks that will rally. It's really important that you understand that this is not an indexed strategy that we're talking about right here. There's always going to be stocks that go up in a down market in every condition. Even if you remember back in when the World Trade Center came down, when everything was crashing down, the stock market was collapsing, what was happening to the defense stocks? Honeywell, you had a lot of the aerospace stocks, you had the military contractors, those were going up. Even with this Ebola scare, I mean, I'm not trying to teach people how to make money from the misfortune or tragedies of others. I'm just letting you know, if you learn how to maneuver quickly into the sectors that will rally during different extreme movements in the market, you'll do very, very well for you and your family. You just have to know how to roll with this and not just be a buy and hold type of a person. Because if you just buy and hold, yeah, and that 7-year cycle comes and all of a sudden, people are holding on for dear life. They're saying, well, the markets always go up. Well, yeah, you could say that if you're thinking at the last 200 years, but what's happened in that 7-year cycle is that, are you willing to give back 7 years of your hard-earned money just because you have a buy and hold strategy and you're not going to do anything about it? I mean, the market guys have a Facebook page. I don't know if you've seen that, but I do post different types of news articles that I've seen. In fact, I think it was Forbes last week. Forbes picked up my feed as I was questioning a technician who was getting everyone long. There was an analyst that was telling everyone to buy Marriott hotel stock, and I questioned that on the technical level, and Forbes highlighted that. And guess who was right? Well, again, I'm not trying to keep the scoreboard, but I had to say something because this gentleman was getting everyone long at the top. And I saw signals that was saying caution, caution, and I just want everyone to know that the charts will give you the leading indicators you need to at least move to cash. I mean, listen, you don't have to be a short seller. You don't even have to go into bear funds. I'm just telling you, when the time is right or when the volatility starts going up, there's nothing wrong with going into cash. Nothing wrong at all. And listen, I'm not talking about long-term play in cash. Interest rates are too low to do that. But at least when things are crashing around you, moving to cash protects your buying power. That's number one. Another benefit of moving to cash, it removes you from the volatility and the stress for a little while. If you're feeling stressed, move to cash. I mean, come on, let's face it. There's a lot of other opportunities that are going to surface between now and whenever you get back into the market. There's no need for you to have to ride out the storm as though we were in a financial hurricane. We're not. You can control the rudder, and that means moving to cash. Okay, there's the diamonds. All right, NASDAQ in the form of the Qs. QQQ. All right, what's happening there? Let me show you. I went back on the Qs, and I started drawing fan lines. Fan lines. Let me show you something here, folks. If you go to the Market Guys website and you go to the very first page on the videos, you see this right here? See this video right here where it says fan patterns? Learn how to draw fan lines. This will give you a very, very accurate read on when trends are breaking down. Not just upward trends, but when the time is right, you could draw fan patterns on the way down, and it'll give you really, really nice buy signals, again, when the time is right. So learn how to draw those fan patterns. And what I did is I drew the fan patterns for the NASDAQ. I started off with this trend, and then you can see the trend accelerated. Again, this is a weekly chart. So then I took the fan pattern, accelerated, and highlighted that trend, and I accelerated the trend a little bit more, and I accelerated the trend to where we had 4 fan lines right there. Now what was happening is I go to the daily chart. Those fan lines should still hold. These fan lines started breaking down. And what usually happens when the most extreme trend or fan line breaks, the markets generally drift back to the previous fan line. And that's exactly what I forecasted. That's exactly what happened. Now, what I think is going to happen, look at the volume here. Keep a lesson on, make sure you're taking notes on this lesson. When prices go up, let's see, here's a question for the audience. Let's see who's been paying attention to the market, guys. Ready? When prices go up and the volume goes down, what is that? Is it bullish or bearish? Let's see who's going to answer that. Again, I'll repeat the question. When prices are going up and the volume is dropping, is that bullish or bearish? Rick, Jeff, Bruce, Tim, Lloyd, John, Ed, Robert, Nathan, yes. You're all right. You're all right. Dave, thank you. Beatrice, thank you. It's bearish. I mean, just think of the volume. Here we go. Use this picture in your mind to really understand what's going on. The volume is the throttle. It's the gas pedal. Think of it that way. The color of the candle is the direction in which the car is going. So if the candles are green, the buyers are driving the car. But if all of a sudden they're still driving and it's going higher, but they're letting up on the gas pedal, that means the upward move is weakening. Does that make sense? So although we still could see higher prices tomorrow, the lower volume tells us the buyers are still not motivated. Now, I'm going to draw a line, but I'm going to quickly take it down because, again, I'm tracking these lines for the people who are following on the weekly market report. Here's another question for the audience, and if you don't know this, I'll show you the video to where to get the answer. Here is a former support level, right here. See, back in October, the prices dropped. It bounced off of the 50-day moving average, that blue line. See the 50-day moving average right there? It bounced that support right there and went higher. Now I'm going to draw a line at that support level. Boom. Support, support. Now, look what happened last week. The prices dropped below support. You see that? What happens? Now, what is this line called? Can anyone tell me? Let's see. Well, Tim, you're right, but there's a line when the former support level is broken and it turns into resistance. What's that called? All right. Lloyd, you're right. Okay? Yes, Bruce and Dave, you're right. It is resistance now. Rick, you're right. Bruce, you're right. It's now a role reversal line. I'm telling you, this horizontal line has made me millions of dollars in the past in the gold market. I'm not kidding you. If you could learn how to just identify a role reversal line and know when to buy or when to sell based on that line, you're dramatically increasing your odds. So let me show you where to get the lesson on that. Go to videos again, and down here, right, I think it's about halfway down. There it is. Right here, see this? This video right here, the role reversal will teach you how to draw the horizontal line. You don't even need to learn moving averages or trend lines. Just learn how to draw a horizontal line using the role reversal, and your world is going to change. Now, for those of you who are option traders, let me tell you what that means. Let's say you're an option trader and you bought a call because the stock bounced off of support. You saw it bounce off of this fan line, let's say. When a stock hits a role reversal line, the option traders could start spreading their position. Now, what that means is they start reducing the risk in that long position by selling another option. I'm not going to go off on a crazy tangent for option traders. I'm just letting you know that the role reversal for option traders is even more profitable because not only are you reducing your risk by spreading the position and hedging it, but you're collecting money when you do that. Immediately you can start collecting cash when it starts hitting a role reversal line, either up or down. Okay, so keep that in mind. So I think even if it goes a little bit higher, remember these role reversal lines are not always to the penny. They're general areas. So from 94 to 95 right here in the Qs, that's going to be a resistance area. Okay, finally, what did I miss here? Russell 2000, did I look at that one yet? I think I did. I think I looked at the Russell 2000. Yeah, I did. That was Head and Shoulders. Okay, let's do this. For those of you that are waiting for the rapid fire stock analysis, why don't you start typing in your stock symbols? And for those of you who have questions, I could take the questions as well, if you have any kind of questions. Okay, Rick says SKK. Let's look at SKK. Hold on. I got to put the symbol in right. Hit OK. SKK. All right, now, the SKK, if you don't see it up here in the title bar, that's the ProShares Ultra Short for the Russell 2000. Now, whenever you hear the term Ultra Short, that means it's a leveraged ETF. And I will raise the caution flag on those leveraged ETFs, because if the market goes up one day and goes down the next day in the same amount, you lose money. If it has to go in a direction for a short period of time and trend in that direction, otherwise you can lose. I'm not going to get into the specifics of that, but before you get into any ultra anything, make sure you read the prospectus and understand exactly how, not so much how you could profit from it, but how it could hurt you. It's kind of like, don't get too close to the lion's cage unless you know a lot about lions. All right, this one could bite you. Now, the ultra short Russell 2000 works opposite, or it's contrarian to the Russell 2000 itself. So if the Russell 2000, if we're expecting the Russell 2000 to drop in price, you can buy this particular stock and it will go up in value. Remember, it's opposite. So right now, it looks to me like it's filling a gap here, trying to fill this gap. And this red line, see this red line right here? Rick, pay attention to that red line. That is the 200-day moving average. Many times, the 200-day moving average, when the stock is above it, the 200-day moving average will act as support. Now let's go take a step back and look at the weekly chart on this. It's going to look a little different. Okay? Now, here's what I think is going to happen, Rick, and this is why you need to protect yourself in this SKK. We are in a trading channel for the weekly chart in SKK. See this trading channel? I've analyzed this before. I had an alert to notify me when it got down to 36.5 to buy this, actually, and it just barely tapped it, and it didn't set off my alert. It missed it by pennies, but nonetheless, anywhere down below the support level at the bottom of the channel, anywhere down here is a buy. Now, what you have to watch out for, Rick, is that it's at the upper part of the trading channel right now. See how the weekly chart looks a little bit different than the daily chart did? So you have to be really careful of this. Now, here are your buy points. I'm going to give you two of them. Let me get rid of this line here. I'm going to remove this drawing, and I'm going to remove, actually I'll leave this one. There's three buy points actually. Here we go. Pay close attention. This is a role reversal support line. Here was former resistance. It broke. It's now very close to it. So if the stock starts bouncing off of this, if you see a green candle, there's your buy point, and you put your stop just below your support level. That's point number one to buy. The second one is if it keeps drifting down, if it keeps breaking down here and bounces off of this level, then you're going to buy on the green candle bounce down here with a stop loss order just below support. And Rick, while I'm doing this, tell me if you already own it and what price if you're already in it. Okay, the third one is actually the most attractive for this. because if I pan out again, if it breaks out over 48 and it goes over the channel, let me tell you, a breakout of an established channel, trading channel or trading range, a breakout over that high would be tremendous, because that could really storm up, and you could see, oh geez, you could see a 40% increase in value in the price of this. Maybe even more, because it's ultra short. Remember, it's contrarian to the S&P, to the Russell 2000 rather. Okay, let me see. Do you have that one? Okay, so you own it at 38.39. Okay, so you're already up on this one. Now, 38.39. So you got in right at the bounce down here. Perfect. Now, even though you're up on the trade, you still should be putting your stop somewhere down below 40. I would say 42.93, right around there. Do an odd number. There's a whole lesson plan on the power of whole numbers and what they mean. You want to put your stop at an odd number. So if it breaks down below 43.92 or something like that, then you would get out and take your profit. Rick, don't worry about getting stopped out and having the stock go higher, because if it goes higher after you get stopped out, remember, your other and most powerful buy point is going to be up over 48, so you can jump back in once the stock is proven to break out. Okay. Ron is looking at KOG. Let's look at that for Ron. KOG, Kodiak Oil. Now, this is a weekly chart, Ron. You don't own it, but I wouldn't be afraid to buy this one, actually. Here's why. The oil markets have gotten hit pretty hard, mainly because of OPEC and what they're trying to do to control market share. I don't know if you watched that news, but OPEC is trying to flood the market with their own supply to more or less deter the shale fields from overproducing. It's kind of like in the days when oil was low, when the Texas oil wells plugged up their drills. It was because price was too low. They didn't have enough profit margin to open up the wells. And it wasn't until oil got over, I think it was $80 a barrel or higher, when they started really pushing the drills through the ground. So, but look what happened. Technically you have one. These are weekly charts. 1, 2, 3, doji, 4, 5, 6 red candles. Boom. You have 6 extreme red candles, and the volume is going up. Now, Ron, watch the volume this week. Watch the volume this week. If you see a drop in volume, and you don't even have to buy it today, you can wait till Friday actually on this one. If you see a drop in volume this week, that means the sellers are letting up on the gas pedal. Remember what I said about the volume being the gas pedal? If the sellers pull back on the gas pedal, it means they're slowing down in their selling efforts. So when the buyers see that, they'll jump in. So I don't see any reason why this one, look, this is a role reversal support level it's at right here. See this? Former resistance was broken here, turned to support here, and it looks like we got a long shadow. So if you buy it, I would buy it around here, actually. I would still take a stab at it as long as you put your stop at right 985 or something like that. I would put your stop somewhere down below here. If you want to be a little bit more conservative, put your stop down here. Put a stop $1.50 lower than where you buy it. You could do that. And I think, if you look at this, this is just an extreme sell-off. And if you look at the daily chart, hopefully my lines are going to stay there. You can see that there's a lot of good room here for profit. I mean, I don't see any reason why this stock can't go from 10.5 up to 13 to test the 200-day moving average. A lot of times it will move back up to the 200 before failing. So I think you have a short-term play in there. I just wouldn't be a buy and hold forever and ever kind of guy on this. I just think that you're in good shape for a short-term trade. Oil markets are oversold. There's some signs of life here. The volume is dropping on the daily chart on the way down, so that's good. And as long as you put your stop in, you should be fine. Okay, Eva, Could you tell me, BTG, do you have a position in this one? BTG. B2 Gold Corp. All right, let's see. Eva. No, you don't have a position. All right, let's look at it and say, okay, where would we be a buyer? Well, this one's a little bit more complicated because the stock has broken down below the moving averages up here, and it pulled back. It's going down from the 50-day moving average after showing a bearish engulfing pattern on Friday. So you got to be careful. That bearish engulfing pattern really has my attention right now. So be careful of that. Would I see the bearish engulfing pattern right there? By the way, if you're new to market, guys, you don't know engulfing patterns, I do believe we have a video in here on that as well. Let's see, spin engulfing patterns. Yeah, here we go. Just go to the video page, and right here is a short video. I think it's, I don't know, 5 minutes long on what an engulfing pattern is, so you can identify that. Okay, so watch the engulfing patterns. Now, Eva, let's play this one out here for a second, and this is where audience participation will come in handy. Okay, everyone ready to answer the question? Here we have a low price stock. It's trading below $5, way below $5. There is some signs of negativity, meaning the 50-day moving average is going down. There was a recent bearish engulfing pattern, as I identified. Can anyone tell me where I would draw a support line on this stock? Okay, here's, and if you just want to watch and learn, that's fine too. I'm going to get my parallel line. Where would you draw a support line if you were trading? Okay, Paul, I see you. I don't know if everyone could see the answers on the Q&A, but Paul's already answered one. Dave, okay, I'll highlight some of yours. All right, Dave, I see your answer. All right, Vlad, Rick, Bruce. Okay, here's what you do. Excuse me. Back here is what's called a hammer pattern. I have identified that in the video section as well. A hammer pattern is a long shadowed candle with the shadow, this vertical line here, is about 2 times the length of the body. This is more of a hammer pattern here, and so is yeah, this one I would say is a hammer pattern, right? It's pretty close. Okay, so hammer patterns are most effective when they're at the end of a downward leg or a downward trend. So you have a downward trend, and then you see this long shadow. To be really safe, okay, Eva, watch this. To be really safe, you would draw your support level right to the bottom of that shadow. That's to be safe. If you want to be, I don't know, not so safe, you could maybe draw to some of the bottoms here and try to connect as many of the middles as you can. All right? To be safe, if you decided to buy this at 214, I would draw my support level right there at 184, but I would put my stop loss order right around 181. I would put my stop below support here. Now, it's good that you have a green candle because that tells us the buyer stepped in today, even though there is a red bearish engulfing pattern there. But to really get the full effect of this, now that we've micro-analyzed this on the daily chart, what I would do is I would go back and look at the weekly chart and see where these lines fall in. And if you look now, a little bit different. I'm going to get rid of this line. Okay, I'm going to get rid of that line, and I'm going to get rid of my stop loss line. Oh, I just messed that one up. Okay, let me get rid of that. I'll remove all drawings and do it all over again. Okay, remember I said right here, draw your support level at the bottom of that shadow. Well, if you go back on a weekly chart, you can see that there is support on these long shadowed candles. You see these? There's a tremendous hammer pattern. Here's another hammer pattern. Here's the third hammer pattern that we've identified. So basically, you have a triple bottom right here. There's a triple bottom. So I wouldn't take all of your money and put it into this one stock. That wouldn't make any sense. However, I do like the gold stocks. I like gold. I like silver. I like them as a long-term inflationary strategy to hedge against inflation. I like them. If I go back even further, leaving the support level in place, what do we have there? This is a 20-year chart of that same stock, and you can see that there's very strong support here. If it starts breaking down below this support, I don't see any reason why you should hold on to it. I mean, really, why would you want to risk a $2 stock going to 25 cents? You know, where there might be some support down there. So I think if you're going to get involved in it, I wouldn't put a tremendous amount. I would just buy some, put your stop, and be done with it. But wait for the candles to turn green and wait for it to pivot. Now, for the option traders, here's what we do for the option traders. Now, for those who are interested in learning options, listen very carefully here. How would you like to get the stock for free? Well, I could show you how to do spreads. Now, the option traders, being that the markets are becoming very bearish, I would sell way out of the money call spreads and try to collect $2 for them. I would sell $10 wide credit call spreads for $2 out of the money on stocks that look overbought or bearish, and I would take that money from the spreads and I would put it into a stock like this and forget about it. As they say in Brooklyn, forget about it. That's all I would do. I would just take the premium from my option trade and reinvest it. And believe it or not, trading options this way can allow you to wind up with a fairly decent portfolio of free stocks with no risk, zero risk. You will take risk initially on the option trade for maybe a month or so, but once that trade expires, there's no more risk because you've parlayed the money into something else that you could hold on to. It's silver. Like, I don't see anyone looking at silver, but look at this. My wife and I really don't care if silver goes to $15 or $10. I really don't care if it gets down here because I am trying to accumulate shares of silver. I'm trying to accumulate as many shares of silver as I can because I do know from my 3 decades of being in the markets and being around for a little while, I do believe, watch out after Election Day. I think the Fed is going to start to hike rates. I think you're going to start to see inflation. I don't see any way out of our debt problem unless they just print more money. What does that mean? Higher inflation. See, how much more can the U.S. population be taxed? For those of you in Canada, you're feeling the pain of higher taxes too. But how much more of a tax burden is the American population going to be able to take before they have riots in the streets? Well, guess what? If the Fed starts printing more money, that's a tax. But they don't look at it as a tax. If you and I went in your garage and started printing money, we'd be arrested for counterfeiting. The Fed could do that to pay down the debt. And what that's going to do, it's going to allow you to have less buying power. It's inflation. So if silver comes down here to this role reversal, even if it gets down to 16, you're still pulling it out of the ground. I mean, you're still getting it cheaper than the miners are pulling it out of the ground. Cost to mine silver is anywhere from $18 to $20. It's now below mining costs, for the small miners at least. Okay, so let's not go too far into that discussion because now I'm getting into a recommendation, aren't I? Vaughn, I don't have any Toronto stocks on this platform, unfortunately. It's all U.S. So if you want to retype a stock symbol, I'd be more than happy to do that for you. NYCB, let's get into that one for Ron. Ron does not have a position in this. Again, this is a 20-year. Let's do this, Ron. I'm going to show you something. Let's do a fan, okay, for display and example purposes here. I'm going to take this low and connect it to that low. See how I'm doing this? I'm drawing fans, and then I'm going to extend out. Now, what do? Can anyone tell me who knows how to draw a fan? Where am I going to start my second fan line? Who wants to help me with that? I know where, but let's see if you know. From the last low. Thank you, Jeff. I'm going to start my second fan line from this low, and I'm going to connect to this low and maybe this low and project out. There's my second fan line. Now remember, this is a monthly chart, so now I'm going to zoom into the weekly. Can I accelerate my fan line? Not really. I'm going to leave it at that. Let's go to the daily chart. Anything? Maybe. I see that this stock is bouncing off the second fan line. Now, I'm trying to build onto the lesson plan here, and I am watching the time. We still have plenty of time to go through some of the other stocks that you're submitting to me right now. What I'm seeing right now is a pivot bounce off of this fan line. This is the second fan line that we drew right here. Here's a pivot bounce. Can you see it? It looks like a V. It's just like this. Boom. And there we go. There's the pivot. Okay? Now, if I zoom in a little bit more, you're going to see that the volume, it's really so slight. But we had a green candle today, and the volume is just, you can't even tell if it's lower or higher from the previous day. So if you're looking to buy this one, Ron, I would actually wait for a more convincing signal, a more defined bullish pattern or on higher volume or something like that. The only thing that this stock really has going for it right now is that it pivoted off the fan line, and the distance between where the stock is trading now from the moving average, let me get rid of this line here so I can show you. The distance between where the stock is and the moving average is quite far. You see, from that moving average to where the price is. See, if you go back, this stock does not like to stay that far away from the moving average. You see, go back in history and you can see. Doesn't like to stay that far away, either up above the line or below it. It doesn't like it. So what I think could happen in your best case here, Ron, is I think it could get back up to 1576 before it hits resistance. So, yeah, can it go up? Is there a good chance it'll go up? Yes. But what are we talking about? 74-cent profit on a $15 stock? I don't think the reward justifies the risk at this point. So I'd probably look for another community bank to get into. For a lesson on what I just described here, I call these vertical lines that I drew, think of those as rubber bands. And as the stock moves away from the moving average, the rubber band gets stretched. And then I have a video on the rubber band effect or rubber band theory. I think it's in here somewhere. But yeah, the rubber band effect right there. You see that? So for those of you who have not gone through the Market Guy library, there really is a lot of information here, and my partner Bill and I are continuing to build content so that we keep the free site more valuable to the general public. I mean, we are all about investor education, and if you can get a very short 3 to 5 minute lesson on what this is, that's not too much time out of your day to be able to go learn about this. So I hope you find that valuable. Okay, SWHC, is that Smith & Wesson? I think that's Brian. Hold on, is it Smith & Wesson, SWHC? Yeah, it is. Okay, Smith & Wesson has done a nice job bouncing here. And I think last time I analyzed this, we identified the gap. So Smith & Wesson has a good chance of going up to fill the gap up here. And I think it will. Smith & Wesson has been very reliable with filling gaps. And right now, there are 2 gaps that are wide open. There's a gap all the way up here as well. You see that? So the stock would need to fill this gap, and would need to fill this gap. So what I would do is, after looking at the daily chart, if Brian, you want to get into this one, I would look at the weekly chart and do your analysis from there. Looking at this, there is a lot of support right here, especially. So if you decide to buy this one, I wouldn't buy too many shares, because if you buy it at 1030, I would probably put a $2 stop loss to put your stop somewhere down below this support. You might think, wow, that's a pretty wide stop. Well, if you're using the 1% rule for managing risk, it'll help you gauge the number of shares that you would buy in a stock like this, even though it's cheap. And again, go back to the Market Guys website, click on video, look at the 1% rule, and it'll help you do the math to calculate not only where to put your stop, but also how many shares to buy. You know, folks, there's a big mistake that so many people make, and that is before they go shopping for their stock, they look at how much cash they have available, and it's almost like they don't want cash sitting in there, so they have to go spend it. Have you ever been in that position where you say, wow, I have some extra money, let me go in the stock market and go shopping? Well, you shouldn't have to have all your cash spent all the time. And the 1% rule helps you control your buying power so that you're not exhausting all of your cash. It's called sizing the position. And when you know how to size your position correctly, not only will you be able to reduce your risk, but you will be able to preserve a lot of that buying power. Okay, Paul, you've waited long enough. NDLS, he's long it at 21. So you're up, what, 20% already? More, maybe? You're up 5%. Good job. Okay. This is a weekly chart, Paul, if you haven't seen that already. Now, I don't know what prompted you to buy it, but you got in. I mean, you did get in at 21. Because if you look at the chart, this stock has been in a downward trend for 2.5 years. So you really picked up a stock that was on the way down. Let's look at the daily chart here, and let's see if we can look at the moving averages. You bought it at 21. Did you buy it as a gap play, Paul? You can answer that one. That's fine. Paul, if you said you longed it at 21, did you buy it when it just crossed over the moving average? Is that your strategy? Well, that would have been a good play if you bought it over the break over the 50 with a gap fill target here. I would be a seller of this one at the $25 level. I would be selling out of that. If you bought it at 21, sell it at 25. And here's why. Can anyone, all right, before I do any zooming or highlighting, imagine that everyone on this call has got the same position as Paul. We all bought it at 21. What are some of the signs that you should be looking for? There's two things right now that really catch my attention. Can anyone tell me why my caution flag would be out? Matt's long at 19. Dave, you're long at 60? Oh, ouch. I don't know if I'd admit that. Okay, what are some of the things? Reverse head and shoulders. Well, that's, yeah. But I'm saying, what would be a caution flag if you're long this one? Thank you. Lloyd got the first one. There's another one. Lloyd said volume. Look at the volume. See how the volume is slowly dropping? But what's the other thing that's got my attention? No. All right, here's the hint. Look at the color of the candles. Am I the only one that sees that? What are we seeing in the candles? What's that called? Again, for those of you who are brand new, you have no clue what I'm talking about, but you will shortly. Okay. There it is. Steve, you got it. Stale green. We have a stale green light. Yes, Lloyd, you got that. What does that mean? Okay, here's the analogy. You're riding down the road. You see the green light way up ahead in the distance. There's no one on the road. You're bored. The radio's off, and your mind is going crazy, and you're now playing games with the green light. How long will it be before it turns red? You ever been there on that long deserted road? Well, this is 1, 2, 3, 4, 5, 6, 7, 8, 9 green candles in a row, and the volume is dropping. You know what? I don't know if I would get greedy and wait for the gap to fill. I think I'd be very happy with my $1.66 profit. I think I'd be taking that right now because there is a good chance the red candle's going to show up soon. And if a red candle shows up soon, guess what happens? The market now turns against itself. That is in the form of overhead resistance. What does that mean? Here's another lesson, even for the seasoned traders. Get this. Imagine now, you're the lucky guy that bought it back here at 17. All right? Oh, and here, now you're a lucky person. You bought it on the bullish engulfing pattern on 9/11 when it was trading 19. Oh, and here's another bullish engulfing pattern. So you bought some more there at 18, and you kept buying on the way up. What happens is these people that bought it at 17, 18, 19, as soon as they see that green candle at 23, I mean the red candle at 23, they're selling to take their profits. See, so the market turns on itself. The buyers who already are in a profitable mode are now starting to sell. Look at this big green candle back here with this huge volume. See this volume back here? All these people have been waiting for it to get into a profitable mode, because after they bought it, they celebrated for 5 days, and then they started sinking deep into their thoughts here. You know, they were saying, "Uh-oh, what did I do? I bought it at 21. Now it's trading 17. What do I do?" But they held on. Now they're barely squeaking out a profit from back here. So all these people, if you total up all this volume back here, all of these people are going to be selling on that next red candle. So I think I made my point there. Hopefully you could see that. And Paul says his stop is above entry. Your stop is above entry. Okay. I still would. Here, Paul, this should help you out right here. Watch. Let me draw the horizontal line. Worst case, your stop should be right below that line. Boom. Tomorrow, if it's red, get out. If it goes up, then move your stop, because this former resistance here, once broken here, will turn into support. So if you get a higher day tomorrow, if you're lucky enough to get a green candle, then put your stop at 22.13 or something like that, and just get out and be happy. Okay. Who else? All right, you know what? I'll need you to resubmit your stock symbols if I haven't done that for you yet. Okay, CBI. CBA, Dave is long at 60. Oh, okay, Dave. I'm sorry. I thought you were long this stock at 60. That's why I was laughing there. Okay, CBI. Oh, you're long at. I'm sorry. I didn't mean to laugh. This is not funny. If you're long at 60, Dave. I'm going to give you some tough love here, man. Where was your stop? If you bought it at 60, here was your support level here. If you bought it anywhere in here, your stop should have been right here. Now, you know what you're doing, Dave? You're trying to get back to break even. And that's going to be tough for you. Here's why. Because as the stock stays down here, this 50-day moving average is going to continue to be brought back down here. So the 50 is going to eventually be your resistance area. So resistance is sinking. And now you have a gap below the market, and you got 3 green candles in a row. The only thing, now make sure, Dave, are you long it at 60 and not lower? Just want to make sure, because I don't want to punish you too much here. Okay. Yeah, I don't know. I just don't like the way this chart looks, because the volume is not showing significant volume on that bullish engulfing pattern back there. See, this is a bullish engulfing pattern that happened on Thursday, and it was a bullish engulfing pattern on low volume. This is after a hammer pattern. See, this hammer pattern is bullish. But if you have a bullish engulfing pattern after a hammer pattern, normally you see big volume spikes there, and I don't see it. That's why I don't. That's why my caution flag is up on that one for you. I mean, I know you want to get back to break even, but I'll tell you something. I think it's best to get out and find something that could really do better for you on the way up. Okay. SLW, Matt, you love silver. Okay, let's go. Let's look at Matt, you're long silver SLW at 1925. Okay. Now, I already made some comments about silver. You're already up on this one. SLW Silver Wheaton is a very, very popular stock. It's kind of like the Barrick Gold equivalent. And the good thing here is that you have a green candle, at least now, over support. I don't like the fact that this green candle was on low volume, because on Friday you had a bearish engulfing pattern. You see that? So you long it at 1925, and the support level for this one is at 1937. So you must have bought it back here somewhere. Here's what I would do. I would do, Matt. I would take that low right there. That low is 1880. At 1875, I would stop out. Again, that's going to also depend on how many shares you bought. But at 1875, I would be out of that if it drops below, because this stock is a very, very technically traded stock. You see this? This is a 3-year weekly chart. Watch the monthly chart on this one. See, this is why I love silver. But as much as you love it, you still have to protect it, because if you don't, if SLW breaks down here, who could tell me where the next support level is? Can anyone tell me? There's a small little support level. You don't have to go all the way down to 2.5. Who could tell me where the next support level is? Can you see it? Let's see. No one's typed that in yet, Jeff. 12. Yeah, there you go. It's right there. Right around there. It's kind of like a little blip here. So that's a big move if it breaks down below the support level. But remember, this is a 20-year monthly chart, and this has shown, at least for the past year and a half, almost 2 years, it's shown really strong support right here around 20. So keep your stop in place. I really like the monthly chart that you have a doji there, but you want to really keep an eye on that. I would add to it on any major bullish signal, an engulfing pattern, a harami. If you don't know what those are, look that one up. Any hammer patterns, definitely I would stay long if those patterns show up. Okay, CRFT, gonna help Ron out there. Keep typing in your stock symbols. I have 3 more minutes. Maybe I could pick up one more. CRFT, Kraft Foods. All right, now this is a monthly chart. Look at that hammer. Holy mackerel. I see that big hammer. Let's zoom in on the weekly. Hammer pattern. Oh, bullish engulfing pattern on the weekly. Like it so far, Ron. You'll long this at 34.68. Good man. Stay long this one. Folks, Kraft Food Company, they tend to be inflation-proof. They tend to be recession-proof. They tend to be depression-proof. People are going to eat. As long as they manage their finances correctly, they can stay profitable. And right now, Kraft Foods looks good. It filled the gap today. It could look better on a breakout over the 200-day moving average. So if it breaks out over the 200-day moving average, move your stop up. Now here's my only caution to you. If you see any negative candle here, below the 200-period moving average, and you'll long it at 34.68, take your profit and run. There's always going to be another time to get back into that. All right, one last one. Ford, Jeff is thinking about getting in, and then I make one last announcement, so stick with me. Ford, be careful. We just have a death cross here. I don't know if you know what a death cross is when the 50 crosses the 200. Be careful. It's below support. It looks like it's pulling back down below support. Jeff, I don't feel comfortable being long Ford at this level. I just don't. Because you're down below a breakdown of this role reversal support. Now it's reversing back to resistance. The next major support level for Ford is going to be around 12. I wouldn't be doing anything until you see a bounce off of 12. This is a double top up here. Not bullish at all. I see the volume increasing on the way down here and still increasing, even though these are green candles, still increasing volume. I wouldn't touch that one. Not with a 100-foot pole. Not yet. Not until you get a signal. Okay, remember when I said the market guys, go to themarketguys.com. For those of you who are new or haven't subscribed to anything yet, we have the weekly market report. My reports have been 100% accurate. We are back on track with these. Go and look at the previous reports, and you'll see how accurate. I leave my lines up. The big special is $1. It's $1 for the first month, and $19.95 after that. You're getting reports every Saturday morning. This report will pay for itself over and over and over again. It'll help you maneuver in the market. It'll help you get a gauge on who's controlling the market, the bulls or the bears. And it's only $1 for the first month, $19.95 after that. You cancel whenever you want. There's no long-term binding contracts or anything like that. It's the best $20 you're going to spend. I promise. Folks, I had a great time. I can't believe that hour went so quickly. I hope to speak with you again in the near future. Remember, this is not a buy and hold market. It's a buy and protect, or even a short and protect market right now. So be careful. Have a great night, folks. Bye-bye.